Welcome back, everyone, to Module 8 Inventory. It's very possible that they will give you a simulation on this module. So I wanted to do Simulation 2 and Simulation 3 just to show you the types of questions that could be asked and the required questions, that required calculations that you would have to make. So, 203, London Inc. began operation of its construction division on October 1st, 2007, and entered into contracts for two separate projects. The Beta project contract was $600,000 and provided for penalties of $10,000 per week for late completion. Although during 2008 the Beta project had been on schedule for timely completion, it was completed 4 weeks late in August of 2009. The Gamma project's contract price was $800,000. Change orders during 2009 added $40,000 to the original contract price. So, the following data pertains to it. We're given information for 2008 and 2009. And then at the top of page 204, it says London accounted for its long-term construction contracts using the percentage of completion method. Enacted income tax rates are 25% for 2008 and 30% for future years. London's income before income taxes for all divisions was $300,000 for the year ended September 30th, 2008. There were no other temporary or permanent differences. Okay, so here we go. They want to know for the year ended September 30th, 2008, I'm on page 204, what is the schedule of gross profit for Beta and Gamma? So here is Beta. Our estimated gross profit or loss as of September 30th, 2008. Well, first of all, the contract price for Beta was $600,000. The contract price for Gamma was $800,000. Okay? Now, less total costs. So let's flip back, and you'll see that costs incurred to date were $360,000. Estimated cost to complete is an additional $40,000. So total estimated cost to complete, is $400,000. That's $360 plus $40,000. Now let's look at for Gamma. $410,000 in total costs have been incurred to date. Estimated cost to complete, another $410,000. So total cost to complete, $820,000. Uh-oh. So total gross profit expected is $200,000 for Beta. We're going to have a loss of $20,000 for Gamma. All right, let's go further. Let's talk about the percent complete. Well, the costs incurred to date from the previous page for Beta is $360,000. Total estimated cost to complete, we just calculated, was $400,000. So this project is 90% or 0.90 or 90% complete. For Gamma, we've incurred $410,000 in costs to date. Total cost to complete, $810,000. So we're 50% complete. All right? So now they want to know what is the gross profit recognized? Again, I'm on the table on page 204. The gross profit recognized is going to be 0.9 or 90% of $200,000. So the gross profit recognized here is going to be a positive $800,000, and it's going to be a loss of $20,000 here. Okay, so now this is the gross profit that Beta and Gamma would report respectively for 2008. Let's move to 2009. Let's move to 2009. Okay, so I'm going to do Beta over here and just keep all the columns the same. So now the contract price is still $600,000 the contract price is $600,000. However, now look in 2009. The project is complete, but the total costs incurred were $450,000. So that gives us $150,000. Okay? Now, here is the problem. No, the contract price is $600,000. Here's the issue. The question is, how much gross profit should we recognize? Well, here is the whole point. The amount of the gross profit that was previously recognized was $180,000. Our actual gross profit on this was it ended up to be $150,000. So we have to subtract $30,000 for the excessive gross profit that we recognized. All right? Because again, we have already recognized in 2008 a gross profit of $180,000. Once we completed the project, we recognized that our gross profit on the project should only have been $150,000. So for 2009, our gross profit has to be a negative $30,000 to recoup some of the additional $80,000, to recoup some of the excessive gross profit that we recognized in 2008. In addition, our gross profit is going to be affected by the $40,000 in additional costs that we have to incur because of the project because of the 4 weeks of lateness in the project. So as a result, we're going to report a negative gross profit of $70,000 in 2009 for the Beta project. Okay, so again, Beta for 2009 will show a negative gross profit of $70,000. Now, how I did this problem was that I left the original contract price of $60,000 and I subtracted the $40,000 in late fees down below. So this is the excessive gross profit. These are the late fees that are deducted. So your gross profit is going to be a negative $70,000. To me, I think this makes more sense. But let me tell you how they did it in the book. Okay, for the book for 2009, they adjusted the gross profit. They adjusted the contract price for the late fees. So the contract price, instead of being $600,000, they made the contract price $560,000. Okay? So then when I take 560 minus 450, I get a gross profit that should be recognized of $110,000. But the problem is, I already recognized gross profit of $180,000 in 2008. So what I've done is, I've overstated my gross profit in 2008 by $70,000. So my gross profit in 2009 for Beta Corporation has to be a negative $70,000. Okay? Now, let me go on to Gamma Corporation. Now, here's the issue with Gamma Corporation. If you flip back to the problem, it says change orders during 2009 added $40,000 to the original contract price. So here's Gamma Corporation in 2009. Now, the contract price, instead of being $800,000, is $840,000. Now, it says that the costs incurred to date, $720,000. Estimated cost to complete, $180,000 more. So the total estimated cost to complete are going to be $900,000. So that gives us a loss of $60,000 instead of the loss that we reported in 2008 of $20,000. So since we have already reported $20,000 of this $60,000 loss in 2008, the amount of the loss that we're going to report in 2009 is going to include that $60,000 plus, let's see what else they have. The beta project was the 800 change orders during added $40,000 to the original contract price. 720, 180, 900,000 billings, cash collections. So I get an additional negative gross profit of $40,000 for Gamma in 2009. Okay? So, boy, that's a bear of a problem, but it's a problem that you do need to go through to make sure that you understand. Let's look at Simulation 3. Simulation 3 is on the bottom of page 205. Let me make sure my pages are correct. Is at the bottom of page 205. Okay, so here we go. Your company sells one product which it purchases from various suppliers. York's trial balance at December 31st, 2008 included the following accounts. So they give us the accounts at the top of page 2006. Then they say York's accounting policy is to report inventory in its financial statements at the lower of cost or market applied to total inventory. Cost is determined under the last in, first out method. York has determined that at December 31st, 2008, the replacement cost of its inventory was $8 per unit, the net realizable value was $8.80 per unit, and its normal profit margin is $1.05. So that's going to come in handy when we have to calculate lower of cost or market. So let's go through 1 through 13 with true or false statements. Okay? True or false? The gross margin method uses historical sales margins to estimate the cost of inventory. That is exactly true. That is the whole purpose of the gross margin method. And remember, the gross margin method is only used to estimate what ending inventory is at interim financial periods. Okay? Now, wait, I lost my pen here. So let me where is my pen? All right, here we go. The dollar value LIFO method preserves old inventory costs by charging current costs to cost of goods sold. Well, in general, that's true about not only dollar value LIFO, but of regular LIFO also. Current costs are charged to cost of goods sold. So number 2 is true. 3, inventory should be reported at the lower of cost or market, and it may be based on the values of individual items, categories, or the total inventory. That is true. Number 3 is true. Lower of cost or market can be applied to individual items, categories of items, or your whole doggone inventory. Number 4, a loss on a purchase commitment should be recorded when the contract price is greater than the market, and it is anticipated that a loss will occur when the contract is completed. That's true. That is true, and that's the perfect definition of a loss on a purchase commitment. 5, under the dollar value LIFO method, increases and decreases in a layer would be measured based upon the change in the total value of the layer. That is absolutely correct. That's true. Number 5 is true. 6, the link chain method uses a cumulative index to value the base cost of ending inventory. That's true. Although it's a minor point, it is true. 7, the price index for the dollar value LIFO is a measure of change in price levels between the current year and the base year. That's absolutely true. Number 8, under the LIFO method, an inventory liquidation will result in higher profits in a period of rising prices. That's absolutely true, because in a period of rising prices, it's the units that have the lowest prices that will be in your ending inventory. So if you start liquidating some of that inventory, it's going to result in a higher profits. Number 9, a holding gain results from holding an item while the market value experiences a decline. What? That's false. Number 9 is false. 10, during a period of rising prices, the LIFO cost flow assumption results in a higher net income as compared to FIFO. That is exactly false and exactly opposite. During periods of rising prices, LIFO results in lower net income because it's the goods that you purchase at the higher prices that are flowing through to cost of goods sold. 11, in a period of rising prices, when a company changes from FIFO to LIFO, the net income will tend to decline, as will working capital. Number 11 is true. It is absolutely true. Why will your working capital tend to decrease? Because, 1, your inventory, remember under LIFO, your inventory will consist of your cheaper items. Working capital is your current assets minus your current liabilities. So under LIFO versus FIFO, your current assets in the form of inventory are going to be lower. 12, the use of LIFO for book and tax purposes will result in a lower tax payment in a period of rising prices. That's absolutely true, because you will have lower tax payments in periods of rising prices using LIFO, because your net income or your pre-tax income will be lower in periods of rising prices under LIFO. Okay, number 13, using the LIFO method, the cost of goods sold balance would be the same whether a perpetual or a periodic inventory is used. That's false, because remember, under a perpetual system, the inventory balance and cost of goods sold, well, let me say this. Under a LIFO inventory system, cost of goods sold is updated constantly every time a unit or a good is sold. Whereas under a periodic inventory system, cost of goods sold is not calculated until the end of the year. And cost of goods sold is based upon the total amount of goods that you purchase, as well as the total amount of goods that you sold. So that would be false. All right, now let me just do the last part. It says on the bottom of page 206, below are statements describing inventory and cost flow methods. Identify which method matches each description by clicking on the correct term and placing it in the space provided. You may use the term more than once or not at all. Okay? Use the term more than once or not at all. During a period of rising prices, this method results in higher net income. That's FIFO. LIFO always results in lower income in periods of higher prices. 2, this method most closely matches the physical flow of inventory. That's going to be FIFO 2. 3, the method that uses historical sales margins to estimate ending inventory, that's the gross profit method. 4, a method that is appropriate when there is a relatively small number of significant dollar value items in inventory. That's specific identification. So someone like a Rolls-Royce dealer or a fur coat dealer, a mink coat dealer, would use specific invoice because they probably have a very small number of high-priced goods. 5, average cost must be calculated each time additional inventory is purchased. Well, for that would certainly be moving average cost, okay? Because it's a moving average. The average cost of inventory changes every time inventory is purchased. 6, method that averages the cost of all items on hand and purchased during the period. That would be the weighted average cost method. Okay? Weighted average cost method. 6, this method results in the lowest ending inventory in periods of rising prices. That's LIFO. 8, method that uses a price index to measure changes in inventory. That's dollar value LIFO. 9, if used for tax purposes, this method must also be used for financial reporting purposes. That's LIFO, and that's the conformity rule. 10, the cost of goods sold balance is the same whether a perpetual or a periodic inventory system is used. And we are going to say that is FIFO. That is FIFO. Okay? So that brings us to the end of 2 simulations. One using the percentage of completion method and one focusing upon inventory. Believe me, notice the wording of these simulations. I can tell you that they have asked simulations using percentage of completion, using inventory on prior exams. So you can do yourself a great favor by knowing how to answer these questions. Okay? All right, well, good luck on Module 8. Good luck on Module 8 inventory. And I hope all of this has been very, very useful to you. Talk to you soon. Bye-bye.